At 6 Meridian, we are committed to exceptional client service and evolving to meet our clients' ever-changing needs in the ever-changing landscape of wealth advisory. That landscape recently changed significantly in the form of the U.S. tax code. In this 4-part series with Mitch Caddell, CPA of BKD Advisors, we will explore those changes and their possible impact on you as you plan for 2018 and beyond. We hope you find this series helpful and informational as you navigate the sometimes complicated world of tax planning.
Mitch, the new tax law that was passed last year has a number of different changes for high-income earners. Can you tell us what's going on with the rate that high-income earners will be paying next year?
Yeah, Andrew, that was kind of a nice little gift that we got in December. Our top rate dropped from 39.6% down to 37%. And they also increased the bracket size, and so now that bracket kicks in at $600,000 as opposed to about $500,000. So we get a little extra income on a lower rate, and then the top bracket doesn't kick in quite as early as it did before. So really a nice gift across the board.
And then what about deductions? Were there many changes to that?
The biggest change probably for most people who file with the standard deduction is that standard deduction is doubled, which is a great deal. Single people are now going from $6,000 to $12,000 on their standard deduction, and married filing joint folks go from $12,000 to $24,000. So for the 70+% that actually file using standard deduction every year, it's going to be a really nice little extra boost that they'll be able to take off their taxable income. For those that itemize, probably one of the biggest areas of controversy that you saw, as we went through the tax law negotiations themselves was the state and local tax deduction. This became very popular because everybody kind of has a stake in this deal. And so consequently, what you end up with is you have now your state and local tax deduction, which would be, your withholding and your estimated tax payments, plus your real estate taxes, plus your personal property taxes, are all now limited in total to $10,000. And that's a huge difference from what it is in 2017, where you get all 3 of those items in full.
Mitch, there's been some confusion about the deductibility of home mortgage interest and also interest on home equity lines of credit. Can you explain further?
Sure. The home equity line has been something that's been around for a number of years, and the interest on that has been limited in the past to $100,000 of home equity line. So if you've got $100,000 of equity, you get 6%. So let's say it's $6,000 of interest deduction that you'd be able to take each year. That is now going away. And then the other piece of the mortgage deduction has been on your first $1 million of acquisition debt, you've been able to deduct your full mortgage interest. That now is going to move down to $750,000 as the limit on the home acquisition debt. So if you've got a higher income, higher level mortgage above $750,000, you're going to see a little bit of a haircut in how much of your mortgage interest deduction you're going to be able to take this year.
Another change that I think has a little bit of complexity to it was the change to the personal exemption and then how that relates to the ability to take a child tax credit. Can you explain more about that?
The personal exemption is something that, quite honestly, over the last number of years, as taxpayers have had higher income, it's really phased out and people have not really seen any real benefit from it. So quite honestly, for 2018, I'm not sure that the phase out of the personal exemptions are really going to have a major effect on anybody's income tax return other than those who are below the phase out threshold, which has been somewhere around $350,000 to $400,000 is where that phase out kind of takes place. So that particular item, I think, was one that Congress could have gotten rid of and really not have any major effect on anybody. For the child credit, though, there is a significant opportunity here because now what's happened in the past is you've had a $1,000 credit that's been limited to income of $100,000 if you're married filing joint before it goes away. Well, now that credit is doubled, and that top bracket where you actually phase out is $400,000. So it's a much larger bracket for you to be able to take advantage of the child credit. So if you have children, you may actually get to see some child credit if you're a higher wealth client.
Are there any other notable changes?
I think the alternative minimum tax is probably one of the bigger items that's going to be interesting to watch this year, because in 2018, we're going to have a loss of miscellaneous itemized deductions subject to 2%. We're going to have a growth in your charitable deduction capability. You're going to have the phase out of some of the mortgage interest deduction, as we've just discussed, and also the state and local tax deduction. And a number of those items affect your AMT income each year. And so I think a lot of those are probably going to disappear now. And so for our folks that basically go into, I would say, a bracket of about $200,000 to maybe $400,000, where those items always seem to affect them for AMT, I think those are now not going to be near the effect that they've had in the past. Plus, another thing that Congress did was they increased the overall exemption by about $30,000 for each category, single as well as married filing joint. And now it doesn't kick in until $1 million of taxable income. So I think you're going to see less and less people in the AMT, but I think it's going to be a real interesting dynamic if you were to sit here and kind of compare prior years to 2018 and beyond, just to kind of see what AMT looks like. So I think Congress maybe actually got it repaired this time.
We've highlighted major changes that have come about due to the new tax law. Every situation is different, so we recommend that you speak to your tax professional as you're planning your tax situation going forward. Thank you for joining us.